Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now in our studios here in Hong Kong for further discussion about one of our top stories is Vlad Savov, Bloomberg Tech editor, looking more closely at these possible curbs coming. Vlad, how likely is this?
Well, that's kind of an open question. As you can tell from our own reporting, these are behind-the-scenes discussions. They're not going to be things that are just going to be flashed as a headline and publicized, really. Everyone wants to do some sort of negotiation, and there's a lot of players, like we discussed in the earlier reporting. There's the U.S. companies, there's the Tokyo Electron in Japan, there's ASML in the Netherlands, and then there are the governments themselves, and they're all kind of playing each other's, they're all playing a role in this. I mean, when you look at it from the other government's perspective, they don't want to make any rash moves ahead of the US election. Everyone's kind of trying to wait it out so they know exactly what kind of an administration they're dealing with, while the companies themselves, whatever nationality they are, they still want to do business with China. It's a huge market, and China itself, its priority is to get as many chips as it can.
It seems like the semiconductor equipment makers have been the hardest hit. We had Tokyo Electron down another 10% today after 7.5% lower. We talked about ASML. Why more of the equipment makers than, let's say, the other chip providers?
They're the ones who are most in line to be affected by any of these elevations and sanctions. You have to bear in mind, we also had an interview with the Nikon president this week, and he said that there's remarkable demand coming out of China. Tokyo Electron, there's a very significant proportion of its sales is now going into China. ASML, likewise, its biggest export market is China. So these companies, their equipment, we're not talking about the cutting edge stuff because that has already been taken up by existing US sanctions on trade with China. We're talking about their more mature technologies. Nikon, this is a kind of an amusing element. They're renewing a system that they designed more than 25 years ago, just because that sort of mature, established tech and chips is really in high demand in China. And it's things like power regulation controllers for EVs, which obviously are a huge industry in China. There's just huge demand coming out of it.
And we saw from ASML that nearly half of its business in the second quarter sales were in China. So, it starts to get to the point where companies might move away from some of these restrictions from the United States. In other words, as we said in our stories earlier, they might scrub American products so that they don't have to pay heed to these restrictions. Is that a danger that the U.S. is fully aware of and considering?
Right. Well, that's the U.S.'s point of leverage. When you think about the entire supply chain, so much of the software and the design and engineering that goes into building the chip-making gear machinery comes from designers in the U.S. A lot of that intellectual property and software is the U.S.'s strength and the thing they can leverage. I'm not sure that it's as simple as ASML saying, oh, you know what, life is much easier without U.S. software and technology. I would imagine if that was the case, they would have done it in-house long ago. So that strength for the U.S. tech industry is still going to be there and is still going to be a lever that the U.S. government can pull.
So who's the biggest winner in this versus the biggest loser?
I'm not sure that there is a massive winner, to be honest. When you impose trade sanctions of this sort, you are cutting into business. One thing that is probably worth mentioning here as well is that some of these sell-offs, I mean, like you said, Tokyo Electron more than 10% down today after taking a big drop yesterday, is largely down to many of these chip-making gear providers have had their share prices surging by 10, 20, 50%. TSMC, NVIDIA, likewise, they're all driving this uprise related to AI. And the reaction may be a bit of an overreaction just because the price have risen as much as they have.
Yeah, it's interesting because we even state in our story that prior moves by the U.S. didn't really affect the sales, the business of, for instance, ASML in China. Why more now?
I would say, again, it's a matter of just addressing the competitive dynamics, if anything. I mean, you also have to bear in mind that Tokyo Electron and ASML's competitors in the US are putting pressure on the government. Now, in this case, they probably don't want this measure. Like we mentioned, it might be a bit too far, but the US government is also trying to position its own national companies better. And there are various approaches. And honestly, again, these are kind of behind the scenes negotiations. And I would imagine, if anything, this is posited as like a doomsday scenario, so to speak, to get Japan and the Netherlands to play ball on a lesser restriction.
On the one hand, it seems like a negative for AI in a sense, that the geopolitics is entering into it. But the mere fact that the U.S. and China are squabbling over this to this level shows you how important that industry is. So what are you hearing from investors? Do they want to stay with it, or are they looking to, sort of run for the hills here?
Well, like I say, I do feel like there's a great degree of sensitivity with these companies for when demand and production for AI products is going to subside. Everyone is watching it really closely. TSMC in our region has become by far and away the most closely watched company. And I don't think that you would do that with a company that is just winning and there's no worries about it. You watch it closely when you're watching out for signs that there's going to be any sort of slip up in demand.
Are we getting close to companies downstream monetizing AI?
That's a good question, Brian. I have no idea how anybody's going to monetize AI. One of the ways that they go about it, it's an emerging trend this year, is everyone's trying to sell AI as a hardware product. So Microsoft Copilot, new laptops. Google, Apple, and Samsung, they're all trying to sell us AI smartphones. So that's kind of using the old ways of monetizing technology with the new technology of AI. But in terms of just, can I create an AI service that will turn into the equivalent of a Netflix subscription? I haven't seen that happening yet.
I guess a lot of the benefits will be indirect in nature, and it might not be easy to actually put a number on trying to monetize what AI means to revenues for various companies. Vlad, thank you very much for joining us. Vlad Savov, Bloomberg Tech editor, with us. Joining us now on the program for some discussion of markets is Brian Krawez, president of Scharf Investment on the markets. Well, one of the things that happened today was that we had a little bit of spreading of the selling in some of these chip makers. It wasn't just confined to that industry. Do you think that this could be the trigger for maybe a broader sell-off in the overall market?
Yeah, thanks for having me. It certainly could be. I mean, one of the things that the first half was all about was tech. I mean, you had the S&P up in the second quarter about 4.5%. But if you look at value stocks, small cap stocks, equal weight, S&P equal weight, those were all actually down last quarter. So it's been a very tech-driven market. And now suddenly, as you guys were just reporting, you've got talk of, both Trump and Biden are talking about putting potential restrictions. You've got Trump talking about tariffs. And so that could be the kind of catalyst that causes a rotation into, lots of other stocks, which frankly are much cheaper.
There's a lot of ways to look at this. I mean, some investors might just say, okay, let me take a look here. How much of this company's product line is really prominent in China? And I'll discount a little bit and trim just to kind of make, take account of that. Others might say, look, I've been looking to lighten up anyway and take some profits, so now's a good opportunity. And others might see this as a buying opportunity. Of the three, which of those positions resonates most with you?
Well, for us, we actually think there's just a lot of opportunities outside of the big tech markets. Right now, S&P is about 45% of what we're calling tech and tech-like. The S&P is about 22, 23 times earnings, whereas the average stock within the S&P or the S&P equal weight is more like 16, 17 times earnings. And actually for 2025, they both have the same growth. Same thing with the Russell 1000 Value Index. So there's just a lot better opportunities in our view. And by the way, if you look at the returns this year, 68% of the S&P came from just the 10 largest stocks. The last time we had a real concentrated market like that was in 1999 with 38% of the S&P's return was from the 10 largest stocks.
Yeah, but the difference is the earnings now from those big companies is much greater than, I suppose, what they were back in 1999, 2000. Do you think that some of those broader type companies that are more like cyclical or value in nature, will they produce the earnings that justify gains?
So that's a real good point. And I've had plenty of people say that to me before as well, is like, well, the companies now are more real than back then. But think about cell phones. One of the top 10 stocks in 1999 was actually Nokia, which was, a cell phone leader at the time. So if at the time you had thought, or if someone had come with a time machine and told you how dominant cell phones would be today versus 1999, you probably would have thought you'd be pretty good in the top 10 stocks, including Nokia and Cisco, which were sort of the internet leaders. But actually, those top 10 stocks over the next 10 years were down 27%, whereas the equal weight S&P was up 65. So I think the moral of the story is AI is going to be really big, but it's really hard to know the winners. There's been about 200 billion spent on AI so far, and estimates are there's been about $3 billion or so in revenue. So there's been a lot of data coming out in terms of questioning when we'll see a return on AI, and we probably will. But knowing who the leaders are going to be and who the winners are going to be is going to be harder than people think. And so a lot of times investors just overpay for what they think is certainty, and it turns out that someone else is the winner in the end.
Yeah. So when you look at the companies that are outside sort of the top 10 or so, I mean, whether you want to focus on the Magnificent Seven or maybe the top 15 or 20, when you look elsewhere in the marketplace, what stands out as the most attractive?
I mean, there's a lot of areas. As I said, if you just look at the average stock in the S&P 500, it's trading at a very big discount to the index itself. So you have a very concentrated market where people are really just incredibly focused on the Nvidias and Apples of the world, and yet there's plenty of smaller companies out there. Just to name one, a company like Gentex, which is very dominant in auto dimming mirrors. They have some really interesting technology coming out where they're going to be able to have full sunroofs that darken. They're already on the Dreamliner, where instead of having a shade you pull down to block the side of the window, you can push the button and it darkens. I mean, this is a company it's grown double digits. It's trading well below its historical averages, and so you can buy it well below where the S&P is trading, and yet it is sort of got a tech aspect to it, and should be able to continue to grow as we move into autonomous vehicles and things like that. It also incidentally fits very much into if the Trump administration comes in and they're looking for manufacturers and U.S. Domestic type companies, and so it fits that profile as well. Yeah. It's just that it's a smaller company that people aren't really thinking of, so it's sort of been sort of forgotten.
In addition to Gentex, you also mentioned Samsung in your notes. While that is a way to play AI, it has a lot of other prongs to its business. What do you like about Samsung?
I mean, there's a lot to like about Samsung. There are some problems with it, but it's very cheap. It's historically been a very good tech company, one of the largest by revenue, dominant in a lot of areas, like you said. What's kind of interesting about them, even just listening to what President Trump said in his Bloomberg interview, talking about wanting Taiwan to play for defense and stuff. So if there's a growing desire to get more chip reliance outside of Taiwan, which seems to be what Trump is indicating, potentially a player like Samsung could benefit. And then longer term, you've got demand for AI regardless of how big it ends up being, and they're going to benefit, as you said, from that as well. Yeah. So there's a lot to like about Samsung.
Brian, thank you. Brian Krawez, our president of Scharf Investment. President Xi Jinping will unveil his long-term vision for China's economy. Xi will be wrapping up the third plenum in Beijing, a meeting on reform that happens just twice a decade. Joining us now in our studios here in Hong Kong is Wei Yao, head of research and chief economist for the Asia Pacific at Société Générale. Wei Yao, thanks very much for coming into the studios. So we have been really thinking that we'll hear more about a continuation of President Xi's policies, things like high quality growth and Chinese-style modernization. Yet it seems like there's pressing need for stimulus. So how do you expect the sort of core of the speech to be?
Well, morning. Indeed, we don't expect much change in terms of the long-term direction that Xi Jinping has made very, very clear and has been implementing for several years now, which is, a double down on China's tech upgrade, supply chain security, rather than domestic demand. So we think it's better to keep the expectation low for stimulus.
Right. And how much stimulus is needed to sort of set the Chinese economy on a more upward pace?
Well, actually, strictly speaking, it's not even a question of stimulus at the moment. It's really that the policy setting is very deflationary. Monetary policy doesn't favor lower interest rate, doesn't want to weaken the currency. And the fiscal policy essentially is more about deleveraging than supporting the economy. So the first task is actually to reduce the amount of austerity in the economy. So any increase in the fiscal impulse will be helpful.
So it's not even reform, really. It's not even, it is reform, but it's not so much extra stimulus needed, but just to pull down the curbs. What are chief among the curbs?
Well, one thing I think it's a bit less noticed is, the fiscal side, local governments actually seems to have the priority of lowering the shadow debt they have accumulated, right? But given, they're missing a huge chunk of the land sales now, so essentially, they're running fiscal austerity.
And we have actually looming quite a lot on the geopolitical front, which perhaps is a little outside the basic thrust of the third plenum, but is looming. You have not only these tariffs coming from Europe on electric vehicles, but also the former President Donald Trump pledging a 60% tax on goods from China. I know that's down the road, but both President Biden and former President Trump want to maintain this toughness on China.
Well, you can say this is even related to the strategy, right? So as now China's policy is very much about supply rather than demand, it just exacerbates the imbalance, which leads to the situation that China is running a manufacturing trade surplus of 10% of GDP or $1.5 trillion US. So everyone's pushing back. So this policy is creating a problem for the world, essentially.
And the real estate downturn is a big part of what's holding back the consumer. Might we expect that to organically fix itself, or do you think there really are some strong policies needed?
Well, if organically, it would take much longer or much worse first. On that front, we see a tiny bit of cost correction this year. It seems that the willingness to put a bottom to the housing is stronger. But the policy still takes time and takes more effort. So it's a bit early to say how, and when this housing can stabilize.
What might be a comprehensive reform that is really needed?
If we're talking about how to support the domestic demand, yes, indeed, they need to first sort out the problem that the local government's just running out of fiscal resource. So some tax reform is necessary, which seems to be on the agenda. But more importantly, it's just that the central government really need to step up borrowing by itself to cushion the system during this transition. Something
briefly mentioned earlier, the hukou system. Is that still serving as a major constraint for people in China?
It's not. It's actually far less than before. Outside of, several major large cities, very big cities, there is not much restriction on people moving around anymore. Even for hukou system, right, to take it to the next stage, to help the domestic demand, it's a question about local government fiscal resource because you need a social security spending to support that.
And do you see very positive prospects for some of these new technologies that are very much at the center of the geopolitical debate? For instance, chips for AI.
In a way, I guess, the fact that the leadership is not overly concerned has a lot to do with, the fact that from their perspective, things are actually going fine on the supply side. So there is a lot of progress. But the problem is that relying on manufacturing alone doesn't generate enough jobs and demand in the economy as big as China. It just doesn't.
All right. Thanks so much for joining us here. Unfortunately, out of time. Wei Yao is head of research and chief economist for the Asia Pacific at Société Générale. This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.